Hello friends, this is Suryapadi. Let us solve one multiple choice question of BEC section of CPA examination. This is question number 33 and you can watch all of my previous questions and answers on my website, that is cpa.suryapadi.com, or you can watch them on my YouTube channel. Question number 33, area 3, cost of capital. DQZ Telecom is considering a project for coming years which will cost 50 million. DQC plans to use the combination of debt and equity to finance the investment. Issue of option A, issue of 15 million of 20 years bond at a price of 101 with coupon rate of 8% and a floating cost of 2% of the par. Use 35 million of fund generated from the retained earnings. The equity market is expected to earn 12% US Treasury bond for currently yielding 5%. The beta coefficient for DQZ is estimated 0.60. DQZ is subject to an effective corporate income tax of 40%. Compute DQZ's expected rate of return using capital asset pricing model CAPM. To calculate CAPM, the cost of capital under CAPM, we need the risk-free interest rate. This is 5%. Then we need the coefficient and we need the interest rate, that is 12%. And let us calculate it. So formula is risk-free interest rate is 5%. Then plus, okay, in this case the formula is the risk-free interest plus coefficient then interest, expected interest rate, that is interest minus risk-free interest. So if we solve this equation, it will give us the cost of capital under capital asset pricing model. So risk-free interest is 5% plus coefficient is 0.60. Then the normal interest rate is 12% minus the risk-free interest rate. Okay, let us solve this. Okay, so we have taken risk-free interest plus coefficient multiplied then the difference of interest rate. So under CAPM, the cost of capital is 9.2%. That is, out of the options given here, option B is the correct answer, that is 9.20%. Subscribe my YouTube channel for more questions and answers and other related information related to BEC section of CPA examination. Thank you very much. Have a wonderful day.